All right, everybody. How's everybody doing today? Thank you for joining us for our training on navigating credit reports and credit scores. Let's give it a minute or two for to give our attendees a time to log into the training. Great topic today. This is one of the ways to definitely make yourselves shine and differentiate yourself from the masses. Um, Shine as a loan consultant and not an application taker. This is also a necessary step when analyzing the loan to see if there's any rapid rescore opportunities to increase the borrower's score, right? You definitely need to know how the whole system works, how to analyze your credit reports, how to analyze the opportunities, regardless of whether a credit simulation is going to be possible to run on the credit. You yourself have to know what affects credit. All right, so let's get right into it. Today's training, navigating credit reports and credit scores. All right, so when we get the credit report, the tendency for a lot of MLOs is just to look at the credit scores and nothing else, right? So do be aware, right? Most of you already know this, but there are three credit bureaus that come into play, three credit bureau repositories that come into play with credit scores, credit reports, right? We have Equifax, we have Experian, and we have TransUnion, right? Those are the three different credit bureau repositories that the creditors report the information on. Some creditors report to all three bureaus, some only to two, some only to one. So that's why that's something to take into consideration also when you're structuring your loans. I have a HELOC, for example, that I'm structuring for a borrower, and the lender where I'm going to submit that HELOC only uses Experian, right? They don't pull from all three bureaus. So then you would do a soft pull, see where the Experian, what's showing up on the Experian bureau for your borrower, and hopefully that's what it's going to be when that loan would get submitted. This is of utmost importance, not just with the credit score, but if there's any derogatories being reported or not being reported on Experian, that could be an advantage. And I think in this particular scenario, the borrower has a couple of collections that are reporting in TransUnion and Equifax, but not reporting in Experian. So that's going to be great because those collections are not going to impact the processing of the loan. So again, do always be aware, the three bureaus are there. They aren't always going to come into play. So make sure you are aware of if there's a tri-merge that's going to be pulled, needed for whatever deal you're structuring, or could it be possible that they're only going to be using one bureau, like the one that I'm handling on a HELOC. So it's very important when you're reviewing that credit. Oh, and I guess let me back up a second. Each credit bureau, Equifax, Experian, TransUnion, have their own algorithm on how they analyze the data. That's why you get three different credit scores usually from a borrower. Besides the fact that, excuse me, not all the information reports to each one, like I said, but they may analyze the information differently. So very important when we're reviewing the credit report that we don't just review the credit scores, but we also review the trade lines, right? The number of trade lines, how long they've had the trade lines, and the other factors that we're going to cover in depth here, like what is the limit on the accounts, how much do they owe on the account. So as you're looking through the accounts, if you see, there's 5 accounts and each of the accounts are at 80 or 90% credit utilization, from what you're going to learn now here in this training, you're going to know that there's some opportunities there possibly to improve the credit. And then you would run the Smart Score simulator. But I'm jumping ahead of myself there. So when you are reviewing the credit report, again, I mentioned about reviewing the trade lines, but you also want to ensure that the borrower information reported is correct, because incorrect information, even for example to the borrower's address, can result in credit score or account reporting errors, because some of the information the system is pulling in based on their name. Some of the information also is pulled in based on the name matched with the address, and then the name matched with the address matched with the social security number. Then you have date of birth. All of these different factors that come into play for the compilation of the data on the credit report. So do be aware that if you're looking at that credit report and the borrower's address is not the most updated address, or there could be a slight misspelling of their name or date of birth, obviously social security number as well could be incorrectly entered. That all can affect the data that's pulled into the report, and then ultimately affect the credit scores. So review the credit report for red flags and for alerts, right? You do get a social security number mismatch alert. If there's any information where the system could say, hey, the number that's being reported now doesn't match the number that's been reported in other inquiries. So it could be either somebody else pulled it incorrectly, or it could be that it just got pulled incorrectly now. So you would obviously want to verify the social security number. Another alert, this is more for fraud purposes, could be that the issue date of the credit report is very recent. So then they ask you in those cases to verify that the borrower is actually a citizen or a permanent resident, that they have legal status here. If it's a credit report, if it's a social security number that was recently issued, right? You got a person, if they're 40 years old, that social security number would have been issued a lot sooner than in the last 7 or 8 years, right? If it was issued the last 7 or 8 years and they're 40 years old, then they're probably are an immigrant, and then we want to check to make sure that the status is correct for the loan type that they've applied for. And then you got the address mismatch alert. That is also an alert that can come up if there's an address mismatch. In other words, the address that was just entered doesn't match the address that was entered in prior inquiries. The system's going to let you know so that you verify the information. If there's an identity theft freeze by the borrower, then you may have the bureau even not pulling up if the customer froze or locked that bureau, or it may simply be that the customer has asked that no credit be extended without verifying from them that they actually applied for it, in which case you will have seen where we need to get that verification letter underwriting asked for, confirming that our borrower is actually the applicant, verifying their identity. If there's excessive credit inquiries on the credit report, that's going to be another alert. If you get somebody with 20 or 25 inquiries, is that really that person doing all those applications, or is there some kind of ID theft going on? So you want to make sure that you identify and correct these errors, and definitely address the concerns with the borrower, right? Verifying all the information to ensure that it isn't an ID theft situation going on, where maybe it's actually not our borrower, or maybe our borrower is not aware that maybe their ID is, their information is being used by somebody else. And all of a sudden they see, no, I didn't make all those inquiries on my credit report. What's going on here? So that then they can be alerted and try to figure it out to make sure somebody hasn't stolen their identification. When reviewing the credit report, also one thing you definitely want to be on the lookout for escape the watch from disputed accounts, especially disputed accounts with a balance, right? That's a key situation there, because for FHA, for example, you could have, if the disputed accounts total $1,000 or greater in balance, then even if you get an approve eligible or for DU or accept for LP, you will have to downgrade that automated approval to a manual underwrite. That verbiage is written in the findings automatically for any FHA loan. For a conventional loan, you may get the approval, and if they're with disputed accounts on there, and then you're going to get one of two messages. You're either going to say, hey, system picked up that there's disputed accounts. The system was able to analyze the risk, including those disputed accounts. Nothing further is required from you. In other words, your automated approval is binding. No need to downgrade to a manual underwrite. However, you could also get the findings that says, we've identified disputed accounts. The system was not able to properly analyze the risk for the disputed accounts. So you're going to have to downgrade your case to a manual underwrite. Now, we do have a conventional manual underwriting option, right? Just like we do have FHA and VA and USDA manual underwriting options. Those are much more common. The conventional is much less common, but we do have an option. But do be aware, in all manual underwrite situations, the DTI is going to be much lower than it is when you get automated underwriting, right? FHA, for example, when you have automated underwriting, you can go as high as 45.9 on the housing expense DTI and 56.9 on the total debt. But if you're doing manual underwriting, total debt drops to 43. Housing expense drops, I think, to 31. And you're not going to be able to increase those DTIs unless you have good, strong compensating factors. And then depending on the compensating factors that you provide is how much higher they would accept the DTI going on the manual underwrite. And with conventional, it's even lower. Conventional, I believe the total debt DTI is maximum 36% when you're doing manual underwrite. So yes, the option would be there to do manual underwrite, is there, but at a much lower DTI. And do be aware that whenever you are submitting a loan for manual underwrite, there cannot be any derogatory credit accounts in the last 12 months. Any derogatory credit accounts in the last 12 months will disqualify the loan from being eligible for manual underwrite. So don't send the loan for manual underwrite and waste time for everybody involved. If you know that there are derogatory credit accounts in the last 12 months, it is just going to be denied needlessly, right? So do be aware of the importance of disputed accounts. One of the things you can resolve with disputed accounts is the customer can take them out of a dispute status, right? Reach out to either the account, the creditor, and tell them that you want to take it out of dispute status, or reach out to Experian, TransUnion, Equifax, tell them you want to take it out of dispute status. It gets taken out of dispute status, but do be aware that for automated underwriting approval, the disputed accounts taken out of dispute status will need to be removed from the credit report. The credit report is going to have to be updated via a rapid rescore, right? Rapid rescore is the process where the information is pushed up to the bureau, and in 3 to 5 days, the information is updated so that the credit bureaus now, when a new credit report is generated, will report the updated accounts, either the balance is lower, the dispute status taken off, whatever was needed on the rapid rescore. But for disputed accounts, if you're doing automated underwriting, you're going to have to do a rapid rescore to take the account out of dispute status so that then the automated underwriting approval can be validated. So do be on the lookout for disputed accounts. So breaking down a little bit more on the actual credit score, right? Now, this is the part that most of you should definitely keep handy, because this is what's going to let you know as you're looking at that credit report before you do your credit simulation where the opportunities may lie, if any at all, for improvement, right? So the first category that has the most impact on their credit score is payment history, right? 35% of the credit score revolves around credit history, payment history. Now, little difficult to change payment history via a rapid rescore unless it was an actual mistake, right, where the account was not supposed to have been reported or was not late, and that can be resolved. And I'm going to give you one prime example of where this can happen, right? Let's say a borrower has a loan on their home, and they were discharged. They did a Chapter 7 total liquidation bankruptcy. They included the home mortgage loan in that Chapter 7, and the Chapter 7 bankruptcy was discharged. Now, mind you, that discharges the obligation to have to pay that loan as a note, but it doesn't eliminate the lien on the property, right? So if the borrower stops paying on their home, the lien holder can eventually foreclose on the property because they stopped making payments. But at no point can that lien holder report that account on the borrower's credit report as being late. They cannot report any late payments. That account cannot even report to the credit bureaus. That loan no longer exists. It was discharged. It's only a lien is only what exists. So if, for example, the borrower says, "Hey, I don't know why my mortgage company is reporting that I've made some late payments on that loan, on the mortgage loan, because that loan was discharged via bankruptcy." So then at that point, the borrower can either dispute that account to get it removed, and also reach out to the lien holder, tell them to take that account off of the credit bureau. That account was discharged with bankruptcy. You're breaking the law by reporting that account, and it'll get taken off. And then you can get a new credit report, and then you're going to have a higher credit score. So that's one example, believe it or not, that payment history comes into play. Just like if there's any accounts reporting, older accounts reporting late that were discharged with bankruptcy, those have to be taken off the credit. Those late payments cannot appear. That account cannot even appear anymore in their credit to bring their credit down. All those accounts disappear. So, I mean, that's the easy one right now. The one where, hey, I was not late, and they're saying you were, and you're saying you weren't. At that point, if they don't acknowledge that you were actually not late and give you the letter, then you have to do a dispute, provide your information, and within 30 days, the creditor has to reply. And if you provide the right documentation that you were not late, like, hey, here's my payment, here's the day it was taken from my account, then they got to fix the account. Most of the time, unfortunately, it's not that easy. Most of the time, they are late, and the information stays on the account. But again, payment history is 35%. Now, if, for example, they have a collection on there that shows as an open collection, and they pay the collection, the payment of a collection right now isn't going to result in an immediate improvement in the credit score. It's going to take a couple of months of seasoning for that to happen. So just be aware, and you can do that. You can check that out when you run credit simulations and put a collection account from unpaid to paid, and see it's going to have very little effect on the credit score. So payment history, little difficult to always better the credit score by eliminating negative payment history situations, but not saying it's never possible. Just be aware there are limitations. Now, amount owed is 30% of the credit score. That could also be called credit utilization, right? The percentage of their available credit that is being used. The higher the utilization, the lower the credit score. Now, do be aware also that the only accounts that we can make that changes can be made to that are going to affect the credit score are revolving accounts. In other words, stuff like credit cards and a HELOC if the HELOC is put as a revolving account and not a mortgage. So revolving accounts are the only ones that can be paid down to improve a credit score. Installment accounts, like a car loan, you pay them down, it's not going to improve the credit score. And with an installment account, if you pay it down to zero and pay it off, guess what's going to happen? The credit score is probably going to go down. Because let's say you have an installment account where the original balance was $20,000, right? And now you're down to $3,000 or $4,000. But it shows that it was originally 20. So you have an account that also could have 2 or 3 years of credit history on it, and it's an active account where payments are being made. If that account is paid off, paid to zero, which is going to close the account, that is probably going to reduce the credit score. So that's not a good method of improving the borrower's credit score. Paying down revolving accounts like credit cards is, but you would always want to do a credit simulation to make sure, because sometimes the borrower has like 10 credit cards of like $15,000, $20,000 limit, and each credit card is at $15,000, $17,000, $18,000. So we're at 70, 80, 85% utilization. Paying one account down may not do anything, right? If they have such a high balance and the utilization level is high, paying one account down may only bring the utilization down, let's say, from 80 to 75, which is really not going to do much. So in that scenario, the borrower may need $20,000 or $30,000 to affect their credit score by paying down balances. So don't make statements that later on are not going to be able to be backed up. It is always best to run a credit simulation before telling the borrower to pay down any accounts for any betterment of their credit score. Definitely when you got borrowers that have very extensive credit. So remember, revolving accounts are the only ones that can be paid down to try to improve the credit score. Third category is length of credit history. I like to call that the depth of the credit. That's 15%. So that's the one that can be affected if you pay off an installment account that had a 3 or 4 year history on it. Now that account no longer is on the credit. Now that good credit history is not being taken into consideration. So the piece of the pie that's 15% there could definitely get affected and actually bring the credit score down instead of up. Now, the other two categories, a little bit trickier. So this is where the credit simulation definitely comes in. But new credit, that's another one where whenever you open up a new account, it has a tendency to reduce the credit score for the short term. Because now you have an account with no history being brought into the mix. So it does affect the algorithm in how the accounts are reviewed. So do be aware. That's why we don't really want to borrow opening up any new accounts in the middle of a transaction, because not only could it affect the DTI if they open up an account and they charge this stuff, but just the fact of opening up the account, the credit inquiry, the new balance, the new limit, the new account, all of those things could come into play to reduce the credit score. And types of credit in use, also referred to as credit mix. That's a very tricky one, right? Not really one that we use too much for the rapid rescore. That's the one that's just going to size up how many installment accounts you have, how many revolving accounts, secured, unsecured, and then, give you a number based on that. So do be aware How all of this works, and again, like the last bullet point says, revolving credit balances are the only accounts that can be paid down in order to increase the credit score. And then last but not least, even though this is more a presentation on credit, reviewing credit reports and credit scores, but definitely a lot of this is with the ultimate purpose of a rapid rescore or a potential for a rapid rescore to be able to better the situation. Remember, the rapid rescore is also a way to differentiate ourselves, or at least mentioning a credit simulation is really what I should state, is a way to differentiate ourselves from all the loan application takers out there, right? That's adding value to the transaction as an MLO, differentiating yourself as a loan consultant instead of an application taker when you're discussing with the customer. Because remember, the credit reports that we pull have included in the cost that's paid for the credit report, Score Navigator is included, which is a credit simulation platform, right? Score Navigator has a couple of different simulations that you can run. But just bringing this up in the transaction is good to the borrower in case it's needed. They know it's there. And like, the borrower has a 760, probably not going to be needed. But if the borrower has a 679 and getting you to a 680 gives you a better LTV or a better interest rate, then you would definitely want to bring that up, right? But do be aware. This is very important. I once had an MLO come to me in a life support meeting, right? And she's showing me the structure in the file, and she's like, "Oh yeah, and I spoke with the borrower about a credit simulation," and she's going over the results of the simulation, and it was like 9 or 10 or 11 accounts, something like that. And because the borrower had a really extensive credit, and I think it was like 2 credit bureaus. So it was 2 credit bureaus, let's say 10 accounts. It was in like 9, 10, 11 accounts. But let's use 10. So 2 credit bureaus times 10 accounts, that's 20 accounts that will need to be rescored, right? The rescore can cost you anywhere from $40 to $50 per trade line. In other words, per account, per bureau, right? Depending on if you're doing a normal process or if you're doing a rush process. So for that scenario, it could have been anywhere from $800 to $1,000, right? And when I saw that situation, I discussed it with the MLO and I said, "Hey, this is great analysis here. Have you already shared this with the borrower? Because let me explain the following. The borrower can never pay for the cost of the rapid rescore, and you're talking about $800 to $1,000 here in expense. So is that something you're prepared to pay? Because it's going to have to be paid by you. And remember that there's no reimbursement here. The only reimbursement you're going to get is you're going to earn a commission on the loan when it closes, but you cannot add the cost of the rescore to the transaction. That's a pure cost on you. And if you don't close this loan, you don't even get paid the commission. So you're out $800 to $1,000. She definitely replied no. She was not aware of that, and she ended up doing a rescore in the end. But I think it was like 1 account. I think they ended up rescoring, and that was that. And that loan was able to close. But it's about discussing the expectations in that scenario properly with the borrower, right? And understanding what it entails, what the simulation and the rapid rescore entails. Now, getting back to Score Navigator before we finish up on the details of the rescore, Score Navigator, which is the credit simulation platform that's included with our credit reports, allows for 3 different scenarios here. It does a few more things, but as far as simulations, these are the 3 scenarios. The first is the Smart Score Simulator, which is a manual simulator. This is similar to the old what if simulation that we had previously, where you can modify the account balances to see the effect on the credit score. So for example, the Smart Score Simulator, if you pick it, let's say for Experian, and it shows the eight or 10 accounts that the borrower has, it shows each account with a balance, whatever it is. And then you can go in there and you can change the balance. Maybe I had a card that was at $3,000 balance. So you put it now at $1,000 balance on that card and you click run. And it's going to immediately give you the result of what would be, based on the simulation algorithm, what would be the new credit score for that borrower if a rapid rescore was successfully completed and the balance on that account was updated to reflect that amount. You can also use the Smart Score Simulator, for example, to undispute accounts that are disputed. This is very important. And see what is the effect on the credit score. Because believe it or not, when you undispute the account that's disputed, it now brings that account back into the equation that the algorithm is going to calculate to come up with the credit score. And in some cases, taking an account out of dispute status, I've seen it reduce a score 20, 30, 40, 50 points. In other cases, I've seen it do absolutely no effect. So do be aware, hopefully by running a simulation, of what is the effect if an account is going to be taken out of dispute status, because if that's the case, then manual underwriting may be the way to go if it is not to be removed out of dispute status because of the drop in the credit score, right? Then that could kill your deal other than a manual underwrite, unless your customer just does not qualify for manual underwrite. So Smart Score Simulator, that's the one where you can put in the balance yourself, right? And see, that's one of the ones I like to use myself, because I like to play around with the different accounts. Target Score Simulator, that was similar to our old Wayfinder. That's the one where the system provides the most efficient path to reach the desired goal. So you put what the target score is. So our borrower currently has a 642. I need at least a 660 to get whatever non-QM programs that I want. Or maybe even to get the approved eligible for DU, I feel like I may need a certain score. So you're going to put the target score in there, and then you're going to hit run. And the system is going to tell you what needs to be done with the least payments, or the least steps possible. In other words, the most efficient path to reach that desired score target. That's why they call it Target Score Simulator. So that's pretty cool. If you just want to put in the number, hit run, and let the system tell you what you can do. I do that one, and then I go and I check the system by running the Smart Score, and half of the time or a little bit more, I can actually find a better solution. But it's cool to have the Target Score Simulator. And then the Money Simulator, that's another interesting one where you enter the amount of money available, what the borrower has in total available to pay down accounts, and then you hit run. And the system tells you, okay, if you have $3,000 available, here's the best that can happen with the $3,000. Pay this down, pay that down, do this, do that. You come up, and the system will run the simulation and let you know with $3,000 what's the best that you can do. So all of those three are pretty cool simulators that are included in Score Navigator, which I do recommend all of you use whenever you have a credit report that's run. It's already paid for. It's included. The customers love it, but do be aware that if this is a short-term scenario, like the borrower is about to get into a purchase or just got into a purchase, any changes to the credit score are going to have to be done via a rapid rescore, and you're not going to be able to wait for the changes to occur organically as you could if it's a borrower that's in a TBD pre-approval situation and has a month or more to wait before they need to be totally pre-approved. So they may be able to wait for the changes to update organically and for a new credit report to be pulled when the time is right. So touching base now on the final details on the credit simulation, like I mentioned, the cost is between $40 to $50 per trade line per bureau. The borrower can never pay for the cost of the rapid rescore. Make sure you only rescore the bureaus that need to be increased. In other words, you don't need to rescore all 3 bureaus if all you're trying to do is increase your middle credit score. Now, if in a scenario you have a 640, a 650, and a 650, right? And you need to get to a 660 middle score, then you're going to have to rescore both bureaus that are at 650, 650, and push both of those up to 660 or above. Because if you only do one of them and it gets to 660, then you're going to have a middle score of 650 and you're right back where you started. Yes, but you don't have to bring all 3 credits bureaus above a 660, right? So do be aware to save yourself money. That would only be the case if you're trying to better the DTI on a borrower. So not only are you looking to increase the credit score, but you're also looking to better the DTI by having that payment not show up anymore. At that point, you may have to update all 3 bureaus so that the system is picking up the 0 payment as well as the 0 balance on whatever accounts you need zeroed out so that you can run your DU properly. And as previously mentioned, for automated underwriting approval to pick up any changes, especially for disputed accounts, will need to be removed via a rapid rescore. Also note that the rapid rescore can take easily 5 to 7 days after they receive the information that they need. They'll review the information, the documentation, and if everything is complete, they'll send it to the bureaus, and hopefully within 5 to 7 days, your rescore will be complete. If you pay a rush, it could be done in 1 to 3 days. I've seen them done as a rush even the same day, right? So it really depends on the account and on the bureau. Now, there is a no doc option for the rapid rescore, but don't choose that just because the borrower is too lazy to obtain the letter that they need, because the no doc option runs the risk of an extended review period of up to 30 days. In other words, it becomes like the customer disputing the information where the accounts, the creditor has up to 30 days to reply. That's what can happen when you have a no doc option, right? So always best to have the customer obtain the letter that they need to show the new balance. The letter can be faxed to them. It can be emailed to them, but it does have to be letter format. It can't just be an email to print out to provide. It has to be a letter, like a PDF document in letterhead, clearly stating the account holder, the account information, and the new balance for that account. That's what you need. And if they get it as a screenshot from their online portal, which is possible, you have to make sure that the screenshot clearly identifies all the information that we need, the account holder, the account number, the balance, and also very importantly that the URL of the page that the customer is on clearly appears either in the top or in the bottom of the page. The URL needs to be appear clearly either in the top or in the bottom of the page. A screenshot from a cell phone is usually not going to work because it usually does not include the URL of the page that they're on. However, if the screenshot from the cell phone has all the information you need, we're not going to discriminate against a screenshot just because it's from a cell phone. If it has all the identifying account information, including the URL of the page that they're on, we can accept it. But 9 times out of 10, it does not have that information. It may have the account information and all the other information, but doesn't have the URL. It's not going to work. So just be aware of that. Save yourself the 1 or 2 or 3 days that you may lose when trying to present unacceptable documentation for the rescore. Try to get it right the first time. Very important to note, borrowers cannot order a rapid rescore. They're never going to be able to order it even if they wanted to. So not only can they not pay for it, can't charge them for it, but they cannot order it. It can only be ordered by the MLO or some other in the biz company. It can never be ordered by the actual borrower. And last but not least, a new credit report will need to be ordered and generated to obtain the new credit scores. It doesn't happen automatically. Now, normally when you order the rescore, they have you check a box acknowledging that you understand a new credit report is going to have to be ordered, and then they do charge in the rescore for the new report. And the new report is usually generated at a lower cost than than ordering a new report independently on its own, right? That could be, 85, I think, is the new cost for a single report, something like that, $85, $90, and the joint report's even more. But when you order the rescore, it's not that much to add on to include getting a new report as soon as the rescore is completed. So do make sure that you do check that box, that you understand a new report is going to have to be generated, so that they do generate it. And it's a nominal fee. It's like $10, $15, $20 extra on the cost of the rescore for the new report with the new scores to be provided. So that's a whole lot of information here, but this is very useful information. So do you have any questions for me today? Questions regarding credit rescores, rapid rescore credit scores or credit reports in general? Because I know somebody was asking something about tax assessments in different states, but that's not a topic for today. So do we have any questions on rapid rescores, credit reports, credit score? This is a great way to add value to yourselves as a mortgage loan originator and get those deals. Definitely going to make you sound like you know what you're talking about, like a true professional that cares about the borrower. Just do remember, don't set yourself up to have to do a rescore on 12 accounts to 2 bureaus unless you're ready to pay $1,000, because that's about what it would cost. I'll give it another minute to see if there's any questions, because today's topic is very important. Maybe I did such a thorough job that you guys don't have to ask any questions, but don't be shy. All right, where do we access these scoring tools? You may have missed it out. Maybe you came in a little bit late, but Score Navigator is an included platform in our credit reports. So when a credit report gets ordered on a loan application where you're the mortgage loan originator, that credit report gets assigned to the MLO. The MLO can then access the credit agency platform who we use. And one of the links that you're going to see on there is going to be Score Navigator. That's the credit simulation tool. So you click on Score Navigator, it opens up, and then it asks you what simulation do you want to run, right? Do you want to do a target score simulator? Do you want to do a money simulator? Do you want to do a smart score simulator? Do you want to do it on Experian? Do you want to do it on Equifax? Or do you want to do it on TransUnion, right? So it lets you choose right there what you want to run. And then you just click it. And there is not an additional cost. The cost for the simulation tool is included in the credit report cost. One thing to note, though, this is super important. That's why you want to do this at the onset of the deal, because the credit simulation is only possible to be run if the credit report is 30 days old or less. Once the credit report age exceeds 30 days, 1 month, then the system will no longer let you run a credit simulation, because it's going to tell you that the credit report is outdated, right? The information is outdated. They can't guarantee the accuracy. And why is that? Because the credit bureaus update. The information in the credit bureaus is supposed to get updated by the creditors every 30 days. So every 30 days on a certain day of the month, and every creditor has a different day, that they send what they call the tapes of all the data to the credit bureau, right? So once a month on a certain day of the month, that creditor sends all the data to the credit bureau and the information is updated. So if that credit report is 30 days or older, then there's a very strong possibility, like 99.99%, that all of the accounts on that credit report have been updated. Now, it could be great if the balances didn't change, but they usually do. And that's going to change the accuracy of the simulation, because then you're going to be running a simulation with last month's data. But what if some of those account balances went up, right? The other account balances, not the one you're trying to rescore, but the other account balances. That in itself is going to change how the system is going to view reducing balances from account A if accounts B, C, and D went up instead of staying the same. You're going to have a different credit score to begin with. So you'll be running a credit simulation on last month's data. It's going to give you an accurate simulation for last month, but not for the accounts as they stand right now. So run those simulations within the first 30 days, because after that, you lose the opportunity to run the simulation unless a new credit report is paid for and pulled. All right, any more questions? That was a good question. I thought I'd have some more questions on credit reports, credit scores. I mean, this is such an important topic to be able to discuss with your borrowers. This is probably one of the most important topics where you can really shine as a loan consultant. Well, I don't see that we have any additional questions. So I do appreciate all of you being on today's training. I hope this will serve you to be able to differentiate yourself as the consummate professional and get you some additional deals. Look forward to seeing you all on next week's training. Thank you and have a great rest of your day.